Most investors never hit financial independence. They chase hot stocks, panic sell during crashes, and wonder why wealth stays out of reach. But there's a different path. One backed by actual numbers, not hype. Let me show you what 100 shares of SCHD can do for your future. Right now, SCHD yields 4.21. That means the 100 shares generates 2087 in annual dividends. Pocket change, right? Wrong, because you're missing the bigger picture. Since 2018, SCHD has grown its dividend by 4/13 annually. That 2087 doesn't stay 2087. In 5 years, it becomes 4050. In 10 years, it crosses 800, all without buying a single additional share. Here's where it gets interesting. SCHD trades at a price-to-earnings ratio of 17. The S&P 500 sits at 26. You're paying 35 less per dollar of earnings. That's not just a discount. That's a margin of safety that protects you when markets turn ugly. During the last major correction, SCHD dropped 21.5. Dividend QQQ down 32. That 10-point difference is the gap between recovering quickly and watching your portfolio bleed. But passive income alone won't get you to financial freedom fast enough. That's where monthly contributions change everything. Add 100 per month to your SCHD position while reinvesting dividends. Based on historical dividend growth, you're looking at 40,000 in annual dividend income in roughly 19 years. Every dollar compounds, every dividend buys more shares, every new share generates more income. And here's the kicker, do this inside a Roth IRA. And that 40,000 annual income is completely tax-free. Zero taxes on dividends. Zero taxes on growth. The IRS doesn't touch it. Let's talk about what makes SCHD different from every other dividend ETF cluttering your brokerage account. SCHD doesn't chase yield, it hunts quality. The fund only holds companies with strong cash flow, high return on equity, and a proven track record of raising dividends year after year. Coca-Cola, PepsiCo, Texas URI. These aren't speculative bets. These are dividend machines that print money through recessions. 30% of SCHD sits in defensive sectors. Healthcare, consumer staples. The stuff people buy whether the economy booms or tanks. Growers don't stop selling during bear markets. Medicine doesn't become optional when stocks crash. This defensive positioning gives SCHD an edge most growth investors ignore. When tech stocks implode, SCHD holders keep collecting checks. When speculation dies, quality survives. The expense ratio? That's 6 per year on every 10,000 invested. Compare that to actively managed funds charging preferences or more. Over decades, those fees compound against you. With SCHD, more of your money stays working for you. Now let's run the numbers on what consistent investing actually produces. Start with 100 shares. Current cost, roughly 7,000. Not pocket change, but achievable for most Americans with a plan. Break it into chunks. Buy 10 shares at a time. Set up automatic monthly purchases. Redirect money from that savings account, earning LDORN 5 into an asset that actually grows. Once you hit 100 shares, you're generating 2087 annually at today's yield. Reinvest those dividends automatically through a DRIP. Every quarter, your payout buys more shares. Those new shares generate their own dividends. The cycle accelerates. 5 years in, your annual dividend income hits $450. 10 years in, you're crossing $800, all from your original 100 shares and reinvested dividends. No additional capital required. But speed matters. Added 500 monthly to that base position, and the math transforms completely. Year 1, you're adding 6 shares per month through contributions, plus fractional shares from reinvested dividends. By year 2, your dividend income jumps because you're earning on a larger share count. Year 3, the compounding really kicks in. Your monthly 500 buys shares. Those shares pay dividends. Those dividends buy more shares. Those shares pay more dividends. Fast forward to year 19, you're pulling $40,000 annually in dividend income. That's $333 per month. Tax-free in a Roth IRA, all while your principal keeps growing because you're not selling shares to generate income. Want to hit that number faster? Increase monthly contributions to $750. You shave 4 to 5 years off the timeline. Push it to $1,000 monthly and you're cutting 7 to 8 years. The more you consistently invest, the faster compounding works. This isn't theory. This is math based on SCHD's actual dividend growth history and conservative market assumptions. Let's address the elephant in the room. What happens when markets crash? SCHD's quality focus isn't just marketing. It's structural protection. The fund owns businesses that generate cash flow regardless of market sentiment. When speculation collapses, cash-flowing companies keep operating. When growth stocks evaporate, dividend champions keep paying. During downturns, SCHD's lower valuation provides a cushion. Buying at 17 times earnings instead of 26 means less downside when multiples compress. Paying less per dollar of earnings gives you room for appreciation. And here's the psychological edge. When you're collecting quarterly dividends through a bear market, panic selling becomes less tempting. That income reminds you why you invested in the first place. It gives you confidence to hold, or better yet, buy more shares at discount prices. Dollar cost averaging through monthly contributions amplifies this advantage. When SCHD dips, your 500 buys more shares. When it rises, you buy fewer but benefit from gains. Over time, this smooths your cost basis and reduces timing risk. The combination of low valuation, defensive positioning, and consistent dividend growth makes SCHD genuinely built for long-term wealth. Let's zoom out to the big picture. SCHD isn't trying to be everything. It's not chasing triple-digit returns. It's not betting on the next Tesla. It's designed to do one thing exceptionally well: generate growing dividend income from high-capital companies while managing downside risk. That clarity matters. Too many investors dilute their strategy chasing every trend. They own a little growth, a little value, a little crypto, a little whatever CMD's hyped yesterday. No coherence, no plan, just noise. SCHD gives you a clear framework. Buy quality dividend growers. Reinvest the income. Add consistent monthly contributions. Hold through market cycles. Let compounding do the heavy lifting. This approach works because it's boring. No excitement, no drama. Just shares accumulating and dividends growing quarter after quarter. The investors who get rich slowly rarely make headlines, but they're the ones actually reaching financial independence. If you're starting today with $7,000 for 100 shares and committing to 500 monthly, you're looking at a realistic path to replacing your salary with dividend income in under 2 decades, all while building a portfolio that could be worth several $100,000. That $7,000 initial investment, in 10 years, assuming conservative growth, it could be worth over $3,000. Add in the $60,000 you contributed monthly, and your total account value could exceed $140,000, all while generating that $800+ in annual dividends. Stretch it to 20 years with continued contributions, and you're potentially looking at a portfolio north of $40,000, generating $40,000 annually. That's financial freedom. That's the option to retire early, work part-time, or simply stop worrying about money. The math works. The strategy is proven. The question is whether you'll actually execute. Most people won't. They'll watch this video, nod along, and do nothing. They'll keep their money in savings accounts earning nothing. They'll wait for the perfect entry point that never comes. They'll convince themselves they'll start next month, next year, when things calm down. But markets don't wait. Compounding doesn't pause. Every month you delay is a month of dividend growth you'll never recover. Every year you sit on the sidelines is a year of compounding you lose forever. The investors who win aren't smarter. They're not luckier, they just start. They commit to a plan and stick with it through volatility, corrections, and bear markets. They understand that time in the market beats timing the market, every single time. SCHD makes this simple. One ticker, one strategy, one clear path from where you are to where you want to be. 100 shares is your foundation. Monthly contributions are your accelerant. Dividend reinvestment is your compounding engine. A Roth IRA is your tax shield. Put them together, and you've got a wealth building machine that works while you sleep. The opportunity is sitting right in front of you. The ETF exists, the strategy is proven. All that's missing is your decision to start. So here's my challenge: open your brokerage account right now. 5 years from now, you'll wish you started today. 10 years from now, you'll be grateful you did! 20 years from now, you'll be living off the income stream you built. The choice is yours. Build wealth slowly and surely, or keep hoping for a miracle that never comes. Start your 100-shore journey today. Your future self will thank you. If you found value in this breakdown, hit that subscribe button for more no-nonsense investing strategies that actually work. Let's build wealth together, one share at a time.